When I close a deal, I feel fantastic. It doesn't matter if it's a real estate deal, licensing, private equity, or even buying a car. I feel great. It's like skiing down a steep run at Palisades or Whistler. You feel elated and you want to do it all over again. The satisfaction of closing deals is what keeps me coming back. I'm Jim Nissing, and as an attorney, business and financial consultant, I help business people win the game of money. With over $1 billion in deals negotiated across custom homes, spec homes, commercial real estate, licensing, pharmaceuticals, manufacturing, syndication, and private equity, I've not only enjoyed great successes, but also learned invaluable lessons from those that didn't go as planned. In investing, you need to know what cycle you're in. For instance, in real estate, there are over 400 real estate markets in the United States. Value may be up in San Diego and declining in St. Louis. The key is getting real-time data to know where you are in the cycles. The same thing is true in investing in the stock market. The trend is your friend until the end. That's what technical analysis is all about. It's based on price, volume, volatility, and time data. What about investing in private equity? There we look at macro trends and the different economic cycles. It's interesting how much investment strategies have shifted over the past 24 months. According to PitchBook, 50,000 startups are expected to go bankrupt or run out of money this year, signaling the end of the unicorn factory era. They also said that $27 billion went up in smoke from 3,200 startups that failed last year. Previously, startups could gain early traction and proof of concept despite losing money, and then sell off to Series A investors who would add little value, make the company appear scalable, and then sell it off again without having any profitability. The old model allowed companies to survive on incremental investments without becoming fully integrated businesses. Today, the market demands fully functioning, profitable entities from the outset. This shift marks a new era where startups must focus on sustainability and profitability from day one, rather than relying on a series of incremental improvements and sales to achieve success. The unicorn factory is closed, and now the focus is on building real, enduring businesses. Real estate returns have also diminished significantly. Real estate has gone down to a 2x return in 10 years. High interest rates, small caps, and notes coming due are big problems. The once reliable multifamily and assisted living sectors have become risky, often resulting in losses. Meanwhile, big tech companies are overpowering small and mid-sized businesses. Traditional methods like tweaking real estate or relying on outdated value propositions are just no longer viable. In 2024, the most successful companies leveraged advanced AI and data, giving them a massive edge over smaller competitors. Take recruiting, for example. Small companies have huge difficulties and challenges in hiring. Big companies get their best talent because they have these large systems. If you need a visual, think of a Chinese industrial fishing vessel versus a small trawler. Their 1,000-mile-long nets scrape up all the fish. Last year, more than 1 million American companies lost their best customers to big tech. Then, more private equity moves into the big companies, and then they turn into the gatekeepers keeping the small businesses out. There's a new formula that works. To make money, you need to find a supply-demand imbalance. You need to find a choke point that's difficult to solve where there's more demand than supply. And the choke point has to be difficult. Not solving a supply issue of protein powder or something like that, but something very valuable. I want to show you an example of a supply and demand choke point. The United States market for engineered stone, which is quartz countertops that you see in most new construction, is an $18 billion retail market. Annually, 200 million square feet are sold, but only 55 million square feet are produced in the United States. creating a significant opportunity. The existing U.S. suppliers can easily sell all that they produce, but the industry faces barriers to expansion. Their choke point is 55 million square feet, and they sell out everything. There are only 5 major U.S. factories that can make these quartz slabs. So why don't they build more U.S. factories? The simple answer is that the way the slabs are made in the United States with the equipment they are made on results in an end product that causes workers silicosis when fabricating slabs for use in consumers' homes. When the workers breathe the dust from cutting and installing their products, it causes silicosis. Now the regulators, consumers, the awareness of silicosis is hitting extreme levels, and many jurisdictions are banning it. No one who runs a factory in the United States will build a new $200 million factory in the face of changing regulations. Build it and it can be closed the next day if they cannot make a safe product in light of the new regulations. And why build a new factory anyway when you already have one that you're selling out? On top of that, operators in the engineered stone industry are not great American entrepreneurs like Bill Gates, Larry Ellison, or Warren Buffett. These are operators more like LG and Hyundai. If you can get around the silicosis problem and give consumers the stone aesthetic and make it in the United States, you have a greenfield, a straight shot at $1 billion asset. This is exactly where money will be made in the cycle that we're in right now. If you can find a huge choke point, drop in a solution for the supply and demand imbalance, then you've created a real billion-dollar company, not a unicorn. So who has this technology anyway? There's one company in the world that has this technology. They've been our founder, Oren Klaff's partner, for 4 years. This company dominates the entire global market for this technology to make silicosis regulation compliant slabs, and now has the solution package to solve this problem and drop it in the US. Our partner, based in Italy, initially faced significant obstacles to get in the US market. They are a 1,000-person company 9,000 miles from California and unfamiliar with the US capital markets and sales practices. With only 5% of their customer base in the US, they lacked a local team and faced high friction in the market entry. 4 years ago, my partner and the founder of this deal started addressing all of these issues. Today, the first US plant will be ready to ship from Dallas this year, and a second plant is in the works. This technology, unique to our partner, offers a clear path to market dominance. With a projected $150 million revenue build and a potential $60 million EBITDA, the company is already preparing for a public offering. I've done my due diligence, and I've been in meetings with the founder and all of the principals. I've seen the data room, and I've invested in this company. This deal is as de-risked as possible, with significant revenue growth potential. It's a deal in a box currently in Dallas, with infrastructure being set up and orders being taken. This deal has the potential to transform the US market. This serious company is targeting $20 million in revenue by 2025 with a 4x return for investors. This company is experiencing high demand and is already planning an exit by late 2025 or early 2026. If you're interested in learning more about these deals and how to get involved, let's set up a call. We can discuss how you can transition from an investor to a banker, secure your place in top-tier deals, and win the game of money. We'll review at least one deal, and if time permits, we can look at others. I'll show you a deal I'm personally invested in. This company has more demand than supply for its products, and it fits the current macroeconomic conditions perfectly. I think you'll enjoy learning about this company. Just click the link below to set up a call.